Welcome everybody. I see a couple of people trickling in here. Really excited to present Gateway Crossing today, the deal that we've been working on. I'll just give this another minute here. I'm seeing people continue to come into the meeting. But yeah, we're really excited today to jump into this opportunity. We're going to talk about the market, the business plan, how you as an investor can make a return on this deal and how you can partner with us on this deal. Yeah, so I guess let's just jump in. I'd like to introduce you guys to Chad Sheeler, founder of Focus Capital, as well as Chad Olson, head of investments at Focus Capital.
Guys, while Mitch is doing that, I want to get a chance to introduce myself as well as Chad Olson here for a few minutes. Well, thanks for your patience, guys, on this call today. But my name is Chad Sheeler, founder of Focus Capital. But it's for several years after really trying to solve a tax problem for myself 8 years ago. And started as a hobby, and now it's a full business and great team and a lot of great opportunities for investors. Chad, introduce yourself as well, please.
Yeah, I'm Chad Olson, VP of Investments for Focus Capital. I take care of acquisitions, dispositions, debt placements for any of our future deals and ongoing deals. Recently, we got our Heritage Square deal closed just a little bit in the same area with the same seller, which we'll get into in the deck, and presented this opportunity with Gateway Crossing that we're really excited to talk about today.
Okay, are we finally in business?
It's up.
Ready to go.
Okay, sorry about that, guys. Always count on technical difficulties, right? So yeah, let's jump into the deal. Multifamily asset in Clarksville, Indiana, just 5 minutes from downtown Louisville. For this deal at $23 million. It was built in 2021. We're anticipating holding the asset for 5 to 7 years. This opportunity is for accredited investors only, minimum of $100,000 investment. And what makes this deal tick is the assumable interest rate. So we're able to come in and assume the debt on this deal at 3.5% fixed with 7 years remaining. That's one of the most exciting things about this deal. And we really like Louisville. There's been very strong rent growth over the past 2 years. 2024, I believe we saw 4.5% rent growth. While a lot of markets such as Utah, where I live, rent growth was flat, if not negative. So strong rent growth. And then as Chad Sheeler and Chad Olson mentioned, they just closed on an asset up the road called Heritage Square, a 183 unit property. And we'll jump more into speaking about that later. But there is an economies of scale story here where we can share management. We'll get efficiencies for having 2 assets under management within 10 minutes of each other. And that makes the prospects of selling the property very exciting at the end of our hold period, because we can market these as a 2-pack, as a portfolio, which is going to increase the buyer pool and let us not only, look at selling these individually to different groups but also go market to a larger institution. So as you can see, projected returns, 15% IRR, and that is net to investors. So that is after fees, after our promote. And we're raising 6.5 million. We're about a third of the way there. So you can see there's an equity multiple range of 2 to 2.4x. If we sell at year 5, you'll double your money. If we hold till year 7, you'll about 2.4x your money. And then very strong cash flow. What we love about this deal is we're stepping into cash flow day one. I'll actually just jump into the next slide here. We're getting an exceptional pricing advantage buying this at over a 6% going in cap rate. And that makes it so the deal is positive leverage immediately, with our cost of debt being 3.5, our going in cap rate being 6. Contrast that to a lot of groups who have done deals that are the inverse, and they're buying at a 5 or a 5.5 cap, and they're originating new debt today to 6. And that makes it so those deals are negative leverage day one, and they have to increase rents to get to positive leverage. So we're buying well below replacement costs at about 143,000 a door. The reason we know we're getting a good deal on that is because we've looked at recent sale comps in the area. Let me pull up my note here and mention to you a couple of these notable comps. Lakeside Gardens, a comp just 10 minutes to the east in Jeffersonville, sold at 186,000 a door. That was built in 2022. So new product, 360 units, and that sold at a 4.8% cap rate. Again, we're getting Gateway to 6 cap. Heritage Square, again, we'll jump into it. purchased at about the same pricing as where we're under contract for Gateway, 143 a door. Avenue in the Highlands sold end of last year at 140 a door, and that's 1965 vintage product. So again, we're 40 years newer than that product, and we're selling, and we're getting Gateway for the same price per unit. Same with Lockwood. That's another property 5 minutes to the west, 137 a door. They just closed. And then there's also some nice comps. One called Reserve at Riverbed, also in Jeffersonville, 264 units, built 2020. They sold at 195 a unit. So to put into perspective, our pro forma at the end of 7 years, we're saying we think we'll be able to sell our units at 187 a door, which is what some of these comps in our market are achieving today, which gives us tons of room to grow. And then the replacement cost story, you guys can still see my screen, right?
Yep.
Okay, just making sure. If you were to go build new product like this today, you'd be 160 to 180 a door that's hard costs, fees, design, closing costs, and you're pushing over 200 a door. So we're really getting this at a great price.
Yeah, thanks a lot, Mitch. Guys, one of the most important things we do on these deals is we stress test the deals to see what can actually go wrong, what can happen. And we'll discuss more about the risks here as well in this time today. But we look at some sensitivity analysis on the exit cap rate assumptions. I think one of the 3 parts of risk in any kind of deal is the exit assumptions. Like, what can we sell a property for in 5 to 7 years? And we've put together a model here based upon, an exit cap rate of 6% being our base case. And this is the baseball analogy, right? I love baseball. And single, double, triple home run. And we always go for doubles. We aren't going to go for these big home runs. Now they may turn into those eventually if we do the right thing and operate well like we have in the past. But for a conservative double, we're targeting a 6 exit cap rate, which I feel is conservative. I think we do have some room to work there. Based on what Mitch just said about other properties that are trading right now in the 5s, either high 4s cap rates. But based upon our current assumptions, at a 6 cap would be pretty likelihood we achieve a double. And let's say that the exit cap rate is 6.25, right? We miss it by a quarter point. Well, the drop in IRR for the investors is only 1.05%, down to 13.95%, the single over there. So what that tells you is, well, most of our return is not banking on appreciation and the sale in the future. What's really happening here is most of your return is being generated from the cash flows, or I shouldn't say most, but a lot of it is, right? So whenever you can have a higher ratio of your returns coming from cash flow versus appreciation, or from cash flow versus the capital gains, then it's a much better spot for you as an investor to where you're protecting more of your risk and preserving more of your capital. So we love seeing those like this to where they give cash flow out of the gate, a lot of cash flow in the whole period, and there's still a big pop at the end, but we're not relying on that pop at the very end to get us the return. And that's why you're seeing here is a very small change in the exit cap rate and what would the IRR would be. Hope that helps.
Awesome. I'll try jumping back in here as soon as I talk. It's probably gonna crash. So we've just got some sample investment returns here. So if you guys look, this is a $100,000 example. If you were to put 100 grand into the deal, here are the distributions you would get back over the life cycle of the deal. And then nice little pop here at year 7 when we sell. So put in 100 based on our pro forma, you're getting back 237 grand, which includes return and your initial capital. And then you can see how cash on cash increases over time. So again, great thing about this deal is you're stepping into some cash flow year 1. And as we implement our business plan, which we're going to get into, that cash on cash should go up. And over the whole period, it's going to average out to about 7.5% per year. Oh, actually, let's go back to this and cover the splits. This is pretty important. So we're being pretty aggressive for our partners on this deal. So you can see net returns to LP assume an 8% preferred return, which means before we as the GP take any distributions or make any return on this, you guys have to make 8%. And then once you guys are making 8%, after that, it's an 80-20 split up to 15% and a 50-50 split thereafter. We're only anticipating a 15 IRR on this deal as is. So where everything sits, we're not even dipping into this 50-50 territory. Chad Olson, would love to have you jump into the business plan here.
Yeah, so with this being a newer asset, and the interior finishes of all the units and everything else are up to standard that we see across most of the new product delivered to the market. There's not a heavy value add lift in the physical sense that we usually are used to dealing with inside of Focus Capital. We've done plenty of heavy value add lifts and changed over hundreds of units. With our occupied rental program, we do love that, but we like when we can get a really good in-place cap rate and we have more of these operational play that we can enhance, which reduces the risk that you're going into when you have a big changeover and moving up rents, moving over tenants, moving them out, all that kind of stuff, and vacancy risk. So for this, what we're doing is this was an asset managed by the original developer, and he tried to manage it in-house for the last couple of years, and that really cost him. That goes into the long part of this entire story of how we're able to get this deal at such an attractive basis and a really good in-place cap rate compared to the rest of the market. And by doing so and by managing it in-house, it really cost him a lot. And so on the expense side, he wasn't spending what he should. The expenses are all kind of messed up. You can kind of see that in the pro forma, where we have the in place and he's running a very low expense ratio that's not normal for this. And it was really one-sided or whatever else. We're bringing in a professional third-party management company that's going to level off the expenses. It's going to run the way we want to do. We're going to spend the money we need to spend on marketing to drive rent growth and drive value creation on the property and run it well. And then we've got some other income ancillary items. So with that, two of those things that are really driving is a proper implemented RUBS program, a utility build back program, where we're going to get compensated for the utilities that the tenants are using on there, which also helps create efficiencies and reduce the expense load that comes from that, because usage comes down as they kind of feel the brunt of what that actually costs. So that's one thing that's not being done properly now. We should be able to recoup about 90% of all the water and sewer bill back, which is the biggest line items, because electricity is already individually billed and sub-metered. We've already done that at Heritage Square. We're already seeing line go up. The other big thing is bulk internet package. So pretty standard on all kind of new A-class and new products inside of these various markets across the country is that when a tenant comes in there, they're going to get their internet package already done for them, and it's just supplied by the apartment complex. And by doing so, we also get to make a little bit more spread than otherwise, because before the system was anybody could kind of slap in their different systems, or you might have a preferred provider that hooks up a box, but you get a very, very low amount of income. In this, we're going to be able to charge a pretty good amount, charge a good amount for us that we get the profit, but they're actually going to see some cost savings relative to what they were paying before. And we're seeing that again at Heritage as we implement this, and they're going to get faster speeds. And so that's a pretty good value proposition that we're able to add, and it's very standard to the market. Those two things are going to drive our income side, along with just enhancing kind of the operations, collecting income, charges, all those kind of things. We're also going to add in some amenities. So these things are kind of missing a few that we'd like to add that we've done at a few of our other properties: grilling stations, pergolas, dog parks, playgrounds for the kids. Both Heritage and this one we've noticed is a very family heavy environment. So playground will do really well for the kids. This is also pretty closely located to the schools, which we'll see in a later slide. So adding in those amenities to give more attracting items for tenants to come to and stay is going to be a big value enhancement as well.
Awesome. And one thing to know while you were talking about expenses, Chad, I feel like a lot of operators who buy multifamily try to assume that they're going to cut expenses. They're going to get in, they're going to make expenses cheaper. We're literally the opposite. If you look at our pro forma, like Chad Olson said, our expenses actually go up. And that's where that rent increase is going to come, getting in that PMR, our new third party property management company, manages 9,000 units in the area, to improve it. So yeah, on to the next slide here. So just an overview of the property. Here's the unit mix. So we're very heavy on 2 beds, 109 2 beds, 34 1 beds. And then we've got 12 3-bedroom units, very large units, almost 1,800 square feet, more of a townhome product. And then we have a couple live work units, which is kind of like a studio with a office out the front. And those sit on the portion of the property that faces the commercial frontage. So you can see the unit mix here. Currently, the rents sit at about $1,200. Our goal with everything that Chad just explained in the business plan on the past slide is to push rents by $100. We're confident looking at the comps, and we'll get into this on the next slide, that we can achieve kind of that 10% bump. Chad, is there anything you'd like to mention here on this slide? Maybe you could talk about the interiors of the units.
Yeah, I would say something, this one of the big advantages here from my perspective is like when you walk into a property to acquire that's only 4 years old, like there's no capex you have to do to it. Like it's already done. It's brand new. And honestly, the interiors are really nice. Like solid surface countertops, stainless steel appliances, great fixtures, LVP flooring, like the 2 to 6 panel doors, which is not very common. A lot of new builds, sometimes people do it really cheap. But they're really big units as well. The bathrooms are great as well. They carried forward the granite quartz and the vanities there in the bathrooms too. It's got a fitness center. It's got a few amenities. There's no pool, but again, we're not trying to be the luxury A plus class property here in the area. We're providing a class A type workforce housing property that's lower than the other competing properties rent wise, to where we don't want to be the highest price. We want to be just below that to give a larger range of tenants that are workforce people there an opportunity to live at and have some cost savings. I would say too, Mitch, let's dig into more of the backstory and the
Yeah.
Q&A part. I'd love to talk more about that with Chad, because a lot of investor questions we have so far is like, well, how'd you get this part of this price? What actually happened? This is a crazy deal you got. So let's save that for Q&A, and let's go over more like a 5-minute backstory on how this whole thing transpired with the seller.
Yeah, Chad Olson, do you want to jump into that?
Yeah,
Or would you like me to jump in?
We'll do it in Q&A.
we'll do it in the
that.
Q&A.
Oh, okay.
Just continue.
So yeah, let's jump into an overview of the market here. Chad Olson.
Yeah. So one of the bigger attraction point is a job story, and that's something we're always looking for. That's what's going to drive rent growth. That's what's going to drive occupancy, staying at a certain level, or it could go the other direction. And with this area, specifically on the Indiana side of Louisville, there's been a lot of investment and a lot of job growth, specifically in what we highlight here, the River Ridge Commerce Center. And this isn't like what you see in a lot of decks and a lot of proposals, which is, hey, we've got this big factory or this big plant that's announced, and it's 5 years down the road, 3 years down the road, a year down the road, whatever they have you. And then, as we've seen the last handful of years, some things have been pulled back or delayed or whatever else. This has happened. This is already going. There's already been 12,000 jobs delivered of the full 18,000 jobs, and they're still planning on adding more. And there's already been announcements to go that route, that they want to add more and continue to build out. And if you look at this over on a Google Maps overhead, you can see there's plenty of land along the river to continue to expand and add more industrial warehousing and headquarters in this specific River Ridge Commerce Center. And so we've already seen the benefits of that, and that's why there was a lot of supply brought here. Goes into the story that we can talk about, and we show that kind of on the bottom left of the slide here, which is multifamily construction. There has been a large peak that happened over the last 2 years, 3 years, where we saw construction starts really come in, and those got delayed and went through all of 24, but starts started to fall off in 24. They've continued to fall off in 25. So we're down almost 70%, if not more, in construction starts just in this market alone, let alone all of Louisville. And we don't really see that coming back anytime soon. We've seen 2 to 3 municipalities implement a multifamily moratorium on development, so they won't be approving any other projects, with a lot of consternation to get through and difficulty. Of the projects that we know about, like 1 or 2 that are still in the process, it's from a local developer that's headquartered in these markets, and they have very deep connections and stuff, but they are at best 2 years away from putting a shovel in the ground, and it's probably longer out than that. But they've been one of the big suppliers of the market. So the job growth story that's there and still growing, and then the construction starts coming to a head while still seeing rent growth, is why we feel we're in like the best position, why we got this for such a good deal, because of all the problems and instability in the market at one point in time. And then now we're going to be able to ride that wave up and see rent growth return and occupancies level off around 93 to 95, which is going to be standard for the entire country abroad.
Yeah, and like just gonna skip forward and we'll come back. Yeah. What I find crazy, Chad, is here's the rent comps, and you can see here these occupancy numbers. Just a couple weeks ago, Slate was at 60%, Lockwood was at 60%, Lakeside was high 70s, Ben was high 70s. It's incredible to see the rate that these are leasing up. And I think the key, like you said, is despite all this supply, there was still strong rent growth. Like that's a really good sign for this market. Let's come back here to economic strengths. Chad Sheeler, would you like to cover this?
Yeah, I think the main thing here, I'm kind of partial to Indiana, been here my whole entire life. I love it. So what's unique about this is that we're only 5 minutes from Louisville across the border, but people love Indiana because of cost of living here and lower taxes. That's why we love buying properties here in Indiana, which is where all of our property is located right now. It's a great place to own and live, and great schools, low crime, and you're still a very, very short commute to downtown Louisville. I mean, you're like 5 minutes away. So it's very simple to go across the river. We've even heard a lot of reports about people moving from Kentucky over the Indiana border just simply because of politics or the economic environment there, or just cost of living, being cheaper on the Indiana side. I think you can see here in the slide the unemployment rate of 3.1% in Clark County, where it's located at right now. Louisville, 3.9%. This is still far below the national average that we're seeing right now for vacancy rates, which is supporting great demand in this market. And then kind of one more note on the new supply, what's really impacted this? Like, why have new developments slowed down? Well, one is moratorium, as Chad mentioned here a second ago, but also we've seen increased costs for construction bills by quite a bit. We've seen tariffs going up. We have new labor costs with the workforce going up as well. This has been very, very tough for builders to get deals to pencil out in these markets. So that's what we feel is a tailwind. We aren't underwriting banking on these developments to be, not starting the next 5 years. We're still baked in that we expect there to be some rent growth, but not as much as we probably should be banking on, just to be conservative here. So I hope that helps, Mitch.
Yeah, absolutely. And I mean, the other obvious tailwind is rates. Those developers can't kick off their new projects because the cost of debt is so expensive. And that also insulates us from the rest of the market. Chad Olson, you want to cover this slide? Talk to us a little bit about our specific submarket, what's around it.
Yeah. So where our location is, as we've kind of mentioned a couple of times, very close to downtown Louisville that you can see right across the river there. Where your cursor sitting is the major Highway 65 that goes through there and takes you to several of those bridges. There are several bridges that you can go across to get into that other side, from New Albany, right down there, two different ones. And then there's even several walking bridges that you can get across. But those are obviously connected more to the Jeffersonville side or right at the south bit of Clarksville. Right next to Gateway Crossing is Clarksville High School, Middle School, and Elementary School. So it's very, very close in relation to with the school system, which goes to more of the family environment. And then you can kind of see highlighted different employers that are around town. So, on the Louisville side, you have Ford and UPS and the major hub around the airport. And then even down there, you have Humana, you have the VA, you have a few other healthcare, a lot of healthcare. That was something that in our DD last week, we found out there's several nurses that are coming over, or some sort of healthcare professionals that are coming over from downtown Louisville and specifically looking to live here, so that they're reasonably close, but they're far enough away, kind of thing, is what the our leasing staff was telling us when we were walking it. We also have the Ridge Commerce Center that you can see out towards the east. We're facing south right now in this picture. And then you have Samtech on the same side and several other major employers. So it's a really good location that gives you really quick access to the highway to get wherever you need to go. And then just to the north, that's not shown in this, is the major mall and all of the retail, Kroger, grocery, all that kind of stuff. That's less than 2 miles away.
Awesome. Let's jump to the next slide here. Chad Olson, why don't you just continue to talk about this a little bit?
Yeah, so on this slide, I think the thing to really highlight is just where we sit in relation with our rents in the 1 and 2 bedrooms specifically. It's right in the middle of the pack, if not a little bit back, and that's exactly where we want to be. Most of these comps are going to need, they've done concessions to get those occupancies that Mitch was talking about up in the last couple months. Because of that delayed supply and all that other stuff, there's only a few properties that are currently in lease up. And so they're just trying to get through there, and they're doing some concessions, but they need their rents to be significantly higher. And we've seen where those need to be. We've talked to these groups. We've talked about looking at their deals to buy them and all that kind of stuff. So we've gotten pretty good insight into several of these deals and comps. And we know those rents are going to move up further now that they've reached that stabilized level between that 93 to 95%. And so we know that there's going to be room to travel, but this is where we want to sit. The one thing I would highlight really is the 3 bedrooms. So our 3 bedrooms are townhome units. The other 3 bedrooms in here are apartment units. There's really no townhome comps in the market. There's a few that sit in some different things, but no amenities whatsoever, and not really an apartment community. They kind of stand alone, and they're small, 20 unit communities or something like that. So our price per foot is in a really good spot on those, and we don't have too many of them. They lease up really well. So even in that context, it's like we have some room to run in comparison to these apartment 3 bedrooms. But like I said, and Mitch highlighted, the occupancies have really gotten to a good spot for most of these deals, and then a few of them are still in lease up that aren't shown here.
Yeah, and one thing to point out is these. So if you look at these light blue squares, this is us, and these are our trended rents. So this is where we're anticipating we're going to get within 24 months. So back when I was breaking up in the call, I kept getting booted out of the call. I was discussing how we're going to push rents by $100, and we have 24 months to do that. We're not trying to do that day one. For example, the one bed you can see we're 675 square feet. There's two comps right here, and a third actually that's smaller than us, that are several $100s above where we're projecting will be. Same story with the twos. So really comforting to see that we're falling in the middle of the pack as far as rents go, and we have lots of room to increase them. This is just a little map to show you where all these are. You can review the deck later to see that, but this is the part I'm actually most excited to talk about, because I think this will explain to you guys how we're getting such a good deal on this. So Chad Schiller, I would love to have you jump in and kind of give the backstory on this.
Yeah, thanks, Mitch. Yeah, this is a long journey. About a year and a half ago, we saw this deal come on market for a pretty high price. I think, Chad, maybe it was 180K a door or so. It was pretty high
Yeah.
back then. And
Yep.
this kind of goes in the backstory. We bought this back in May from a developer who has previously done a lot of retail development, and now he started doing more multifamily development. And he's a great builder by all means, like built it really well, very efficiently. It checked all the boxes for our insurance company, gave us a great insurance rate, it's very safe, great location. But the mistakes he made were really around the management piece and lease up because he's self-managed. And when you bring it when you bring a property to the market 3 times over a year and a half period of time, you just have a shrunken buyer pool. That's what happened. And us as Focus Capital, we kept our nose to the ground and we offered all 3 times and just stayed firm. And we didn't win this deal initially. It was back in December. It came to the market again, and we were actually second buyer in line, and we missed it by like 500K. Well, as most deals do nowadays, that the first buyers usually can't fulfill their obligations, and they couldn't get it done. And the seller came back to us, and we got it for a little bit lower price when we first offered on it, and we got it for $146,000 a door, which was great comp in the market at that point in time. And this deal as well had great fixed debt. We didn't assume it, but we had great fixed debt going in this deal, and it's been a great property so far. We've already implemented a lot of our programs there. We've had great traction with the PM company, and now that we've got Gateway Crossing just 10 minutes away, this really presents a great opportunity for both properties to benefit on the scale aspect. So better economies of scale. And what that means really for investors and for us property owners is that now we can actually share some of the payroll on both properties. And what that means really is both assets aren't really big enough to support 2 maintenance techs and 2 leasing people, right? It's really kind of like 1.5. If you were at 200 units per property, it'd be a 2 and 2 kind of scenario. But now that we've got Gateway Crossing, now we can really kind of share half of that one maintenance guy on both properties. So now we're going to actually see efficiencies on both properties, we believe. We've still underwrote this property to stand on its own 2 feet alone, but we believe we'll see more efficiencies with both together being 10 minutes apart.
Yeah, great. Thank you. Chad Olson, anything to add here?
That gets it all summed up.
Yeah, I think this is really at the end of the day what gave us the leverage with Gateway Crossing is the fact that you guys had the rapport with the seller. You had just shown them that you could close on an even bigger asset, Heritage being 183 units. How much did you have to raise on this one?
That was 10.2 million. And actually, you made me think of something I forgot to mention as well is the reason we got Gateway Crossing, kind of go into the backstory here, is Gateway Crossing was under contract the entire time that we were buying Heritage Square by a different buyer. And same as Heritage, that buyer couldn't follow through. They couldn't raise capital. They couldn't find a key principal for their debt, and they had to back out. Once we closed on Heritage Square, I know the seller personally now, and we were talking. And I said, "Hey, how about Gateway Crossing? We executed here for you on Heritage Square. We can look at Gateway Crossing as well." We spent about probably 5 or 6 weeks negotiating, and he took almost a $2 million price cut on this asset. And he did that only because for him, it was so important for him to be done with it and do his next project because he's a merchant builder than to try and wait for the highest price and be strung on again for those 6 months. It was more important to him to have the best terms and to be with somebody who can actually close on time than to have the highest price. So we were the beneficiaries of that.
Yeah, that last group was, to my knowledge, under contract at 24.8 million, and
Yep.
we're the next group to come along at 23. So, like Chad
Yep.
said, $2 million haircut. Pretty exciting. This is actually something that we should cover that we never talked about. This structure here is actually an office building that's also on the site. They didn't want to give us this building. This is actually where the owner / developer was contracting his employees out of. What gets me excited about getting this is, that can be part of our marketing plan when we sell to the next group, is they can come in and convert this building to bigger amenity space, bigger gym. Chad Olson, I don't know if there's anything you want to mention with that, or if you think I covered it.
Yeah, it's just it's kind of an extra piece. We wanted it mostly for control. I mean, that was kind of a big sticking point towards the end of the negotiation was we set a number and, we were kind of going back and forth on whether that would include the office or not. But we just got to a point that, it's integrated into this site, as you can see from the pictures. And we want to have control now that we're taking over it of who goes in there. And we hope to find a good tenant that's going to be more of like they're going to start with leasing, probably buy it later, but someone that's really not going to be super impactful to the site, but if anything, accretive to the site is what we're hoping to find here in the next several months. We've already engaged listing brokers on the commercial side they walk the property during due diligence, and we're going to be kind of up and running here in the next couple of weeks, most likely. But that's why we did it. We just wanted control, and then obviously by doing that, we got it all incorporated. If you were to back that price out, the multifamily units look a little bit better on a price per door. But we're not really assigning any true value to this. We wanted the property to stand on its own, just on the multifamily side, because that's what we like, and we were looking at it first. And so we're just going to try to find a way to increase the value, increase income from it by leasing it out to some other tenant, and we'll be able to do that pretty quickly from what the brokers are telling us.
Yeah, and one thing I admire about you guys, throughout the negotiations process and bidding process is you drew the line in the sand of where you weren't going to cross. So, first round of offers, we submitted 23 together and we got to best and final. And apparently, according to the brokers, there were a few groups that were higher than us, is what I recall. But, we drew that line in the sand. We knew exactly what we needed this for. We weren't going to go 250K higher because our goal is to double our investors' money. And so that's what we were targeting to. And
Yep.
At the end of the day, they came back and chose us, even not being the highest bidder, but because they know that we can close. So just wrapping things up here, most important thing on this slide, talk about the tax advantages. So for every dollar invested in this deal, there's 80 cents back in depreciation. So you get depreciation that you can go use to offset passive income. If you can't use it all up front, that will carry over until you can use it. Consult your CPAs on that. And then I think the call kind of kicked me out when I was talking about this. I don't know. Did you guys cover the supplemental loan while I got kicked out?
No, but we can. Basically, we have an original loan that you kind of talked about, which is super attractive. It's about 14 million right now, and that's sitting at about 3.53, and that's great. Like, great rate right now in the context. On Heritage Square, we were able to get all in at a 4.86. That was with a buy down and just timing, kind of getting lucky in the timing of the markets. And usually with the assumption deals, what you kind of stuck with is I have an amazing rate, but I'm paying a premium, and now I have a low LTV of 50% say. And that's fine if you're finding a good cash flowing deal and you've got the good cash flow to return on that equity, but it usually kind of tightens the deal, makes things a little bit tougher on some of the return basis and stuff because you're not maximizing that leverage. With this, because of it being separated by phase one, phase two, it's actually accretive to us, and we're going to be able to take on, as you said, a supplemental loan. But I wouldn't call it a supplemental loan because it isn't. And if we were doing a supplemental loan, that rate would be significantly higher. We're actually getting a loan on the second phase that's totally eliminated from this other property, but it won't be for the investors. It'll be the same. And so we're able to get some of the more attractive pricing. We actually just got our quote back the other day, 10 bips better in pricing than what they were expecting. So that's all good because of mission driven, so on and so forth. So that rate probably will be at worst a little over a 6, especially where rates sit today on the treasury. But that's with our cushion, 25, 30 bips of cushion. When we originally quoted, it was in the high fives, and I think we'll end up in there. So what we have there is kind of the worst case is 415 to 425, and that's a weighted average cost of capital between those two loans. And so we're still going to be 60, 70 basis points under where we're at with Heritage, and hopefully even better. And we'll see how that turns out towards the end. We'll be at loan commitment probably in a month or so. Probably in a month, and we'll know exactly what rate we're going to get.
Yeah, and then just one other thing I'll point out here on this slide is the fee structure. So on a lot of our past deals, we've actually done a 3% acquisition fee, and that's one thing I admire about Focus Capital is they said we're going to do 1.5%, we're going to stick with it. They do have a 1% disposition fee on the back, so that's when when we sell the asset in 5 to 7 years. But the way Chad Sheeler explained that to me is it aligns us better with you as the investors. Less upfront. We want to increase the value of this asset, and so we're essentially carving that fee up into two and taking the second half of it when we successfully sell it. Chad Sheeler, looks like anything you want to mention here?
No, that was very well said, Mitch. I think it's just so important to create elements of interest with the LPs and the GP. A lot of groups don't do that. I see a lot of groups that take a big fee up front and then not much at the very end, and that might be great for the GP, but what incentive is there to keep working hard the next 5 to 7 years to get a fee in the back end when that should be the alignment, right? There should be alignment where the LPs are put first. There's maybe fees up front to help keep the lights on, right? Break even for your fee business, but really the GP return should come once you execute the business plan. Once we do our job and we pay back, your capital, your preferred return, whatever, like that's when we should get paid once we've done our job. And that's just been my belief.
Love that. Okay, so I guess one more thing to cover here on pro forma. We're assuming a 3% average rent growth in our pro forma, which is right in line with the market. Again, 4.5% last year, 3.5% the year before that. Again, we're being very conservative on expenses, underwriting a vacancy factor of 7% in the first 4 years, and then 5% after that once we're more stabilized. Focus Capital, I guess you guys have already introduced yourself. It'd be kind of nice to get an introduction to who Chris is, as he'll be the asset manager on this.
Yeah, thanks, Mitch. So you met myself and Chad Olson already. By the way, Chad Olson's a very humble guy, but he came from a big developer nationally here, and he has a lot of experience in acquisitions and debt and all this stuff. So I'm very lucky to have him on board. Chris Brown, asset manager, full time here in office. He came from Greystar, huge company managing over 3,000 doors himself. A lot of student housing and multifamily properties there. So he has a wealth of knowledge there over 10 years, and very lucky to have him on board. And then obviously Tracy in the office, and that's our team right now. Keep it lean and mean.
Love that. Yep. And then let's jump into your portfolio here for a sec. I think this is one of the other exciting things about the deal. And this is why Elkstone was very excited to partner with you guys at Focus Capital, seeing that this is your backyard.
Yeah, thanks, Mitch. Like I said, we've always focused on Indiana right now. We probably will expand eventually into Ohio and Kentucky. They're great Midwest states. We love the markets there. Some are actually tops in the nation right now. But Indiana's been our home base for a long time, my whole entire life myself. But right now you can see our properties that we've owned and sold on the right-hand side of the screen. But we've done 11 deals so far. We've sold 4 deals so far, executed the business plan on those at an average IRR of 44%. And those were all value add deals. And really our our timeline's been now we're selling off the earlier deals that we first acquired that were with my own money initially. We first started raising capital from investors, and now we're doing larger deals that are better to scale, more efficiencies. They're newer, less problems. They're not quite as old, and they're in better areas now. So that's where we're at right now.
Awesome. Okay. And then you guys already know us, Silkstone Capital team. So next steps for this deal, register your investment. You guys should all already have the portal, and I'll follow up after this. You can go in, you'll make an account. It's a website called Cashflow Portal. It'll have you fill out some questionnaires. We just finished the PPM, the subscription docs. So you'll fill those out, you'll sign those, and then you can officially wire in your funds. So the first distribution will be, first of all, distributions will be paid quarterly, beginning in Q4 of this year. And then we'll send out monthly email updates to update you on the progress of the property. Each spring, you'll get a K1 to give to your CPA. And then as far as timeline for the deal, we're taking funds up until August 31st or until we subscribe, whichever happens first. Targeted closing date is mid-September. And then again, first distribution by the end of the year, and then a potential sell sometime between 2030 and 2032. So yeah, I think it's time to just jump into a Q&A here. If you have questions, go ahead and put them into the Q&A or drop them into the chat. Looks like we already had one come in. Please elaborate on your assumptions for valuing the sale in 5 to 7 years. Yeah, great question. So I can start and then Chads can jump in. So we're assuming an exit cap rate of 6%. Usually it's a red flag if you're buying an asset, let's say at a 6, and we're assuming we're going to sell it at a 5 cap in 5 to 7 years. So for conservativity, usually you don't want to go lower than what your in-place cap rate is. And so that's the strategy we've taken on this one. We're buying it at 6 cap. We're saying we're going to exit at 6 cap. And we kind of talked about this at the beginning of the call, but what that looks like on a price per door is 187 grand per unit when we sell. And again, there's comps that are achieving that today. So we're pretty optimistic that we'll be able to achieve that exit.
Good one, Mitch. I'll go ahead and step in here. We had several questions from our last webinar. People asked that were really good questions. I thought maybe it'd be good to kind of go over these for you guys. Some of the attendees here might be thinking the exact same thing. So if you guys have more questions as we discuss this, feel free to put in the chat. But one of the questions we got is somebody said, where's the upside? I'm always used to value add deals. And there's so much of these value add deals in the market, and we're good at those too, right? I get that. I love those deals. But the upside here really is in the operations and the basis and the assumed debt. So what I mean by that is, normally core plus deals like this, they shouldn't be a 15 IRR. They should be like a 12 or a 13 all day long. They're just a safer investment, lower risk. You don't have to do a lot of construction, renovation. You don't have to go do all the big rent bumps to achieve the return. And with this deal, that's very, very important to us, because if we can get the similar return as value add without doing all the work, it's just kind of a no-brainer, right? If you get paid for the risk you accept, which in this case, you actually have a lot lower risk than value add, but you're still getting very similar return to a value add deal. So I hope that kind of clears that up. One of the question I had last time too is, do we have any concern selling the property in 5 to 7 years, since we are buying at a lower cost per door as it was a distressed seller? And why do you think you had trouble selling it, this inheritance? We kind of already discussed that actually. But we have no concern at all in 5 to 7 years. Like Mitch mentioned, we have comps today that are selling for a higher price point than what we project in 7 years. So to translate, like we have 7 years to essentially get to that point from 143 per door, which is a very plenty of time to do that. Mitch, any questions you've got so far from your investors that you want to discuss in the call today that might help some of the people on the live panel here?
Haven't had any more live questions come in, but maybe we can kind of browse through the frequently asked questions on the deck. So we've already answered several of these here. I think we covered depreciation. Hope that's straightforward for everybody. Let's see. Minimum investment amount, 100 grand. Average investment amounts on prior deals have been 180K and range up to $1 million plus. We've talked about the returns. We've talked about the hold period. Is this investment secured by real estate? Yes, of course. Focus Capital discussed their track record. Again, past returns aren't indicative of future results, but very strong track record. It's been incredible what they've been able to achieve. We've talked about the management. Can I invest with an IRA or retirement account? Absolutely. Can you invest with a 1031? Absolutely. If you're selling any property today, maybe talk to this, Chad. I believe you already have a 1031 investor coming into this. We're going to structure this as what's called a TIC.
Yeah. So we have one, potentially two people that are investing in this property via 1031. It is a minimum $1 million in that investment amount. We have about a week left to accept those people. And the kind of reason why is a lot of timelines have to match up perfectly. Like they have to already sold the property or be selling the next couple of weeks. If that's something you want to talk about, let us know. We can get it put in there hopefully in time. But we have to structure it with the lender, with the legal team. It's more complex, but we can accommodate those, and we're happy to do that if you have an exchange property. One thing I want to discuss too, Mitch, is now that we've already finished our due diligence walks last week in the property, it's probably time to discuss like how'd that go? Like what did we see there?
Yes.
Any red flags? So we walked 100% of units on site. That's really important to know because a lot of other operators might only walk a portion of those units, just like maybe half or 10%. We're very detailed here. We're very full scope of what's going on there. And that way we know like, well, maybe a couple of units are trash or somebody is not actually living there. They should be living there. So it helps us really refine the rent roll and get clear on the true picture of the property. But overall, we saw a great property. And one guy asked me, well, is there anything else you're going to add to the list of CapEx after seeing the property on site? And yes, we are. So we did notice that a lot of these doorway trims around the doorways were very weathered from water or from the sun, right? And it appears as though maybe the seller just didn't, he only put primer on there. But as part of our CapEx plan now, we will be going through every door and sealing and painting those entryways. Very minor expense, but yeah, that's what we found so far. Maybe a few broken blinds, but overall, the property is in great condition, great shape, and we're very happy to have this one.
Yeah, great. Super good news that there was nothing crazy during the property walk. I think this is a good question. Do I stay in the deal if a refinance occurs? You want to
Yeah,
talk to that, Chad? Sheila?
yeah, absolutely. Yeah. I thought it was really important adding here because the question I get sometimes from people is like, well, if you do a refi in 5 years and you keep holding it, like I've always heard that you're gonna like buy me out as an investor. That's not what we do. So you as a membership interest in this property, you will stay in the deal until we sell it someday. So if there's a refi happening in 5 years, we keep holding for 5 more years, you're still in the deal, you still keep cash flowing. That wouldn't be an issue at all. And then the question came in a second ago about any plans to convert to monthly distributions. Yes, that is a plan. Again, we're conservative guys. We don't distribute day one when we buy the property. Like you can't do that. It's a business. But we usually allow about 2 months of full operations, see where it is, distribute capital out, and that way really we can have a lot of reserves to weather storms. The last thing I ever want to do is distribute capital too much to you guys and then come back a month later and say, whoops, went too far. Let's pull some money back and capital call. So that's not what we're going to do here. But yeah, the plan will be eventually to go to monthly distributions to have a more regular cadence for the investors. But as of right now, it's quarterly.
And when you're talking about the last point with the minor things to do on the property, I just remembered, Chad. So we've got an operating reserve budget of 130 grand. We've got a lender required CapEx budget of 300 grand over the hold period, so about 40,000 per year. And then we also have our CapEx budget to do our exterior improvements that Chad Olson mentioned of 250,000. So is that correct?
No,
So you nod your head.
no, the 250 that we have is the CapEx for this all inclusive. And then we will do 250 bucks per unit per year going forward. That's the only requirement from the lender.
Right. Yeah, that's what I meant.
Oh, okay. I
Sorry
thought
if I said something
Yeah.
different.
Yeah. No, all good.
Perfect. Any other questions, guys, before we wrap? Looks like we might have had a third come in. What assumptions does your analysis use for economic conditions? I understand it's hard to predict the future, but there are worrying economic signs, inflation, unemployment, etc.
Yeah, I mean, it's difficult. I think we have the rent growth assumptions. We also have expense growth assumptions, and the expense growth assumptions are the ones that are going to take into inflation that would degrade that, right? They're usually more than enough, 3% here, 2%, 3%, and that's where the Fed currently is targeting to go back into. We saw some amount of expense inflation over the last handful of years. Most of those came in the latter part of this inflation cycle that we saw. And ever since, we've seen them leveling off. We've had several Yardi, CoStar reports and the like come out just in the last year or so that show expenses kind of dropping below 1% of inflation and increasing cost. We really think that technology is going to be a big part of keeping the inflation and expenses low over this next bit. We've already kind of seen it with AI technology coming into the property and being able to take off some of this payroll or enhance them so that productivity is better. And okay, so now we're going to be in this conversation of whether yeah, certain things cost more, we have more AI, but productivity goes up and increases. And so it's an interesting dynamic that we'd be a part of. That's on one part. Um, then on interest rate, which is another big portion of this that we've seen a lot of volatility in for, and where rates go, well, we're taking that out by taking on fixed rate debt over the next 7 years. And I think that's a pretty big part because it's our biggest line item in this entire stack that we're going to put together to acquire this property. And we know, you know, beyond a shadow of a doubt, here's our fixed payments for the next 7 years that we need to hit. Unemployment, I think it's hard. Yeah, it's hard to determine like this part, this market, this market. But what we really focused on is where the unemployment sits now, where it's historically sat over the last handful of years, which not looking at the COVID period because we know how much of a weird period that was, but before, and then the trend of going forward. And we looked at that. We saw the River Ridge Commerce Center. We saw what Louisville has and the major kind of employment employers that are there, their headquarters that are there, and feel really strong that that's not going to transition away. They'll stay the same, if not increase. And on the Indiana specifically, that was an area that had no investment for the last 20 years, from 2000 to 2020, 2015, or what have you. So there's no investment on that side, which is why we saw so much kind of spiral up in the last handful of COVID years, and a lot of money go in there with the River Ridge, with the other employers, and then with the development on the multifamily side and single family communities. There's been a lot of investment in the school as well. Jeffersonville, Clarksville, New Albany have really drastically changed what they used to be, and their downtowns are far more vibrant. So even if we look at Louisville as a whole on this microcosm and this micro market inside that MSA, feel pretty good about where employment could go. But yeah, it's difficult to predict, and that's why it's more of a focus on the buy and where we're coming in at, the basis that we're getting in at, the cap rate we're getting in at. And that's the thing we can only control in this given moment, right? And then we can reasonably predict, working with our third parties, working with our property manager, working with our experience from behind on what we think this pro forma should look like, and then having conservative exit assumptions down into the future and being able to adapt to whatever comes. To the point at the very beginning of the conversation that Chad talked about with kind of more of the returns coming from cash flow distributions, well, that's indicative of what we can do on the back end. If we're in an environment and we can't sell for some reason, or it's just not accretive to sell at that moment, well, we're going to be kicking off cash that we should be able to refinance in that moment. Because in that moment, rates should be cutting down. The economy's in a bad spot. That's the environment we would be in. Okay, well, we'll refinance. We'll get everybody's money back, and we'll continue to chug along. You guys will still be invested in your same percentage, and we'll move forward, right? That's a very unlikely scenario, but it's something that's in our back pocket and gives us the flexibility of all these options, which is what feels really strong about this investment.
I would add one more thing to that, Chad. And I'm glad you kind of mentioned the basis thing, because I think that the question maybe came around, well, what's the risk here, right? The risk in unemployment, the inflation, what's the risk that expenses go through the roof? And I think it's important to look at your break-even occupancy in this deal. That's something to look at as well every single time. Like what all could go wrong and then still break even and pay the debt? Because in real estate, number one rule is keep it from the bank. Keep the property owned. Don't give it back to the bank. Number one rule. Number two rule is pay your investors well, right? So in this example, with this property, our break-even occupancy, Chad, correct me here, low 80% range.
Yeah, it trends that way. Yeah.
83, 84. What that means is we could fall to 84%, for example, for an entire 7 years occupancy-wise and still break even on the debt and hold the property. So what that means is most properties have a break even of around 90%, maybe 92%, right? Very small margins. But because we have this very low attractive fixed rate debt, and we have a lot of cash flow, we can weather a lot of storms. So if things do come up, like we have a lot of padding here to still make it run well.
Yep. One common question that comes up, I don't know if we covered this today. Are we investing in this deal alongside our investors?
Yeah, thanks for mentioning that, Mitch. Yeah, so the GP as a whole will be well over 5% of the total equity contributed on this deal. Myself, I'm putting $250,000 in this deal, and myself, we have a couple other partners as well that will be as well. So I think it's very important to have that alignment of interest in the GPs and LPs. So I'll be alongside you guys as well as an LP too.
Then we have one more question. Are you planning on increasing the rent on the 3-bed, or is it staying the same? Answer there is it's staying the same. There's no increase on our 3-bed unit. We're top of the market already, and I think that's where we'll end up. Any other questions, guys, before we finish? Did we just have another come in? Nope.
Yeah.
Chad Olson, Chad Sheeler, any other questions you can think we should address that we haven't?
No, thanks a lot, Mitch, for having us on here. Glad to kind of contribute any kind of our value in our our experience and our notes on the deal. But thanks to all you guys that jump on the day, middle of the day here on Wednesday. So thanks for your time. Appreciate it.
Thanks, everyone. Talk soon.